Hello, everyone. My name is Scott Walker, annuity product specialist with Gradient Annuity Brokerage. Today I have with me Jay Rosenkrantz. He's a relationship manager at Athene. He's going to start us off and introduce our featured guest today. So, Jay?
Thank you, Scott. Appreciate it. And Scott mentioned I'm pleased to have two distinguished guests from Barclays, Elias Crockless, who's going to give us an overview of the U.S. equity markets, and Laurence Black, who's an advisor to Dr. Robert Shiller. For those of you that are familiar with the Annexus lineup of fixed index annuities, you know that performance is the cornerstone of those annuities through Annexus, and Shiller has been a leader in those indices that are available, both the Shiller Cape Index, which has just had tremendous performance over several years, to include 20% increase over the last 2 years. And then they've also added a Shiller Global Index, which is a nice diversification option. So Elias is going to start us off. He's the vice president on the team responsible for U.S. equity strategy and U.S. small and mid-cap strategy. Prior to joining Barclays in 2013, he was a quantitative analyst at McKinley Capital Management since 2009. He earned a BS in mechanical engineering and an MS in quantitative and computational finance, both from the Georgia Institute of Technology. So with that, I'll turn it over to Elias.
Thanks, Jay. Yeah, as Jay said, I'm a vice president of equity strategy at Barclays Capital. And today I kind of want to go through two things with regards to the U.S. equity market. So the big thing happening lately is that rates have been rising pretty quickly. Started last November and really been picking up steam, the last month and a half. I really want to go through why that's happening, the implications for the U.S. equity markets, and really, when is it going to become a concern for higher rates? Because there's a lot of discussion around that. And then the second thing I want to go over is the rebound in earnings for U.S. companies, very specifically the companies in the S&P 500. Earnings have been very, not strong lately, but they've rebounded much quicker than originally anticipated. And the expectation is for that momentum to continue in 2021. So I want to go over the implications for that. So recently, the yield on the 10-year Treasury for U.S. Treasuries has been going up pretty quickly. It was about 0.5%, maybe, a couple months ago was at maybe 1% at the beginning of 2021, but now it's shot up recently in the last couple weeks. So the way to really think about, U.S. Treasury yields is there's really two components. You have the overall yield, which if you buy, a U.S. Treasury, that's what the coupon's going to be. But you can split that up into inflation expectations and what we call the real rate, which is really just what you're really getting on that coupon adjusted for inflation. So, because if you think about it, if the 10-year Treasury is yielding 1%, but inflation is 2% over the same time period, the reality is you're getting less purchasing power, right? Because you're going to get 1% return, but inflation goes up 2%. You're actually in the hole at minus 1%. So what's really happened, let me just drive through the whole thing since the pandemic and up until recently. At the start of the pandemic, inflation expectations cratered, and so did the long-term interest rates, basically the 10-year U.S. Treasury yield. Now, as things kind of normalized a little bit last summer, inflation expectations started to rebound back somewhat, but yields remained low, right? So then the real rate was very low. So if you look at this graph here in the bottom half, the dark blue is going to be what the actual 10-year yields are. The light blue above it is going to be the inflation expectations, and then the green is the real rate. So, everything cratered during the first part of the pandemic, and rates stayed low really all the way through 2020, even as inflation expectations started to go up. But recently, the real rate has gone up sharply too, and we consider this a pretty good sign because in many ways, the real rate is a proxy for economic health. right? You know, if yields for the 10-year Treasury are really low and inflation expectations are higher, and people are still putting money in U.S. Treasuries, that means people just don't feel like safe in the current investing environment. So as real rates are going up, and they've ticked up lately in the last month, it's a good overall sign. So we've broken it up. We have the inflation aspect of the rates, and we have the real rate aspect. So, you know, for inflation, why is that going up? So really, to think about it, there's kind of a push and a pull aspect where you have inflation because there's higher demand for goods and services, and there's inflation because there's a lot of additional money supply and that money's moving around faster. So there's kind of both. And, you know, one big demand aspect of inflation is the better than expected vaccine news. And one supply aspect of inflation is the high level of U.S. household saving rate. So for the vaccine news, you know, really what happened at the end of 2020, once the vaccine was announced, you know, we had the light at the end of the tunnel, right? So before that, who knew how long it was going to go on? Nobody really knew. But once the vaccine came in with a very, very high efficacy, a lot of the expectations for reopening and things getting back to normal were pulled forward. So you combine the really strong level of vaccinations that have picked up steam now with the falling rates in new COVID cases and hospitalizations, and the expectation is, you know, we're just going to get back to a relatively normal environment much quicker than originally anticipated. And so people are going to have this money and they're going to want to go out and spend it once things get back to normal. And because, you know, of what's been going on in the last year, they have kind of more money than originally anticipated. So what happened in 2020 is that, you know, spending was down, wages were down, but government transfers, you know, the stimulus checks, the enhanced unemployment, everything else were up. So as a result, savings in U.S. households were up pretty substantially as well. So we've seen a pretty significant increase in the cash buffer that U.S. households as well as U.S. companies have. So when things get back to normal, you know, the people will have money, they'll have additional cash that they have the ability to then go out and spend in goods and services that right now they're constrained to spend anything because, you know, things aren't open and they can't go out and do anything. So that push forward for things opening sooner than anticipated, combined with this higher level of cash in U.S. households, is kind of, you know, a demand aspect of inflation and a supply aspect. So there's two other, I'm going to be drafts of them, but there's two other things we've identified that could be causing this higher level of inflation expectations. One of them is, you know, global supply chains have been very disrupted over the last year. Anyone who's ordered anything in the last like 3 to 9 months is well aware. You know, things are taking longer. It's more difficult to get goods, and because of that, there's less supply of goods. The inflation, you know, people pay more for them. There's inflation there from just a limited level of demand. Now, a limited level of supplies. Now, another aspect is that, you know, since there's a Democratic majority in the Senate, and they're pushing a high level of fiscal stimulus, even beyond what the current pandemic stimulus at 1.9 trillion is. There's also a lot of discussion about additional infrastructure spending and fiscal stimulus on that end for clean energy initiatives. That could put a lot more money from a policy perspective into the system. That could also just drive higher supply of money and increase inflation. So, you know, why are real rates rising? You know, inflation's been kind of ticking up in expectations for the last year. Why are real rates rising all of a sudden? Well, I mean, this is really more of expectations improving for the economy. So now what this graph shows right here is this is the consensus of all the published economists of what their expectations for U.S. 2021 GDP is going to be. And for most of 2020, it was right around the 4% range, but at the start of 2021, it's ticked up all the way to 5.5%. Our own Barclays economist, his projection, I think, was 4.1% at the beginning of the year, and now it's gone all the way up, definitely in excess of 6%. So there is a much stronger expectation for growth for the U.S. economy in 2021, even than there was, a month and a half, 2 months ago. So that's a big reason why the real rates are increasing, because they really kind of coincide, as I said before, with better economic expectations. All right. So now here's the question everyone wants to know: is this a problem? Are higher rates bad for equities? There's two ways we think about this, and the main thing is they can be, but not at these levels, and they're going to have to get much higher until they become an issue. So we've done a lot of historical analysis, a lot of run-in the numbers, a lot of empirical analysis, and from what we've seen is that rates do not become a headwind for equities historically until at least 3.5% for the 10-year yield. So right now the 10-year is at 1.5, 1.6 today. So it has a lot of room to run until it becomes a problem. And this is just based on the historical relationship we've seen between the yield and equities. So this is actually really apparent in this chart down here. So if you look at the light blue line is the yield on the 10-year treasury. So it starts in the 60s, is at like 4%, it peaks out in the 80s at 16, and now it's basically almost near zero. The dark blue line is the correlation between equities, changes in equities, and changes in rates. So when it's negative, rates going up means equities went down. When it's positive, rates going up mean equities went up as well. So you can really see this correlation has been positive, sometimes it gets near zero over the last 20 years, but it's been relatively consistently positive since the late 90s. So since the late 90s, when rates have gone up, equities have gone up as well. So that's something where, in the late 90s, also the U.S. 10-year Treasury yield was at 5%. So we think this is a pretty good way to look and think about how equities move with rates, and the fact that it's going to take a while for rates to become a headwind for equities. So another interesting thing is, we talked before about decomposing, rates into the real rate. So, the yield adjusted for inflation, and then the inflation expectations. So even though in general, the general idea is that real rates are a better indicator of economic outlook, we find that changes in inflation really are what drive equities. So this dark blue line is the correlation between equity moves and inflation expectations. So it's generally positive. Inflation expectations go up over the last 20 years. Equities move up as well. The move in real rates is near zero correlation, so it's not as big of a driver. And also, I guess one more good way to think about this that I probably glossed over earlier is that, when rates are really low, inflation is not a big concern, right? Deflation is the big concern. So if rates, if your 10 years yielding 1%, you're way more scared of deflation because you're really close to a deflation scenario if inflation expectations are 2%. Now, if inflation was at 10% and inflation goes higher, it's a big deal, and rates go higher, it's a big deal. So that's a good way to also think about the interplay between the level of rates and how rates move with equities. When rates are low, everybody's worried about deflation. They're not worried about inflation. So rates going up is like good news, everyone's happy. When rates are too high, everyone's worried about inflation getting too high and getting out of control. So rates going down is kind of a better thing overall. And this is what you saw, in the early 80s. Rates were very, very high. Inflation was very high. As they pulled back, the equity market recovered. Okay, so that's enough about rates. The other major point to talk about is that U.S. earnings, specifically companies in the S&P 500, have rebounded very quickly. So really the thing that's happened, and as we said, is the V-shaped recovery in earnings has been realized. And what that means is that if I look at the earnings per share, which is the earnings per the share of company within the S&P 500, that for the last quarter, 2020 Q4, is back to the levels of 2019 Q4. So it's back to the pre-pandemic levels. So basically, it's had a complete V-shaped recovery. Now, this recovery was, much faster than the financial crisis in 2009. It was faster than, the tech crash and rebound in the 2001 recession. And it was much faster than was originally anticipated last summer. So if you look at the dark blue line, this is what actual earnings are. So they were pretty, steady in 2019. They dipped really hard through 2020, and then they've recovered back to where they are right now, a little bit above 2019 levels. The light blue line is what fundamental analysts at, basically sell side, fundamental analysts, this was their expectation during the middle of the pandemic last June. So they thought it was going to be much worse and take much longer to recover. Originally, it was anticipated that it would be 2021 Q3 or maybe 2021 Q4 before earnings for the S&P 500 as a proxy U.S. equities got back to this level. So earnings have rebounded much, much faster than anticipated. And really, it's no surprise. The main reason is, earnings were just better than what analysts were originally projecting. We call that the earnings surprise. So actual earnings that companies realized was much stronger than what was projected from equity fundamental analysts. So it's a very positive thing for stocks. And you can see also this green line is now the expectation going forward. It's expected to continue to rise through 2021. There we go. And that's also, a very positive thing now is that expectations are improving for 2021. So, 2020 is over. What we saw for most of the year is that 2021 numbers were not moving at all. So this is the earnings per share. So the expected earnings for 2021, very far down, dipped in the original, start of the pandemic, is more or less flat. But now you're starting to see some pickup. So basically, expectations for earnings for this year are already up 5% year to date. That's the biggest move. 2018 was a big move because of the Tax Cut and Jobs Act, pushed earnings expectations up there, but it's the second biggest move in like the last 20 years. So, these stronger earnings expectations now for this year should also propel the markets to better returns. And you're also, just as a brief aside, you're seeing, kind of larger increases in earnings expectations in energy stocks, material stocks, financial stocks, a lot of those companies that were really beaten down during the pandemic. So in summary, rates are up, not a big headwind yet, got a ways to go until they become a headwind, and earnings has been really strong. The momentum, we're back to 2019 levels much sooner than anticipated. And 2021 expectations rising, so there are two, recent good positive catalysts for the market. And that is it for me.
All right, very good. So we will turn it over to Laurence Black. Again, Laurence is the advisor to Dr. Robert Shiller. Laurence, whenever you're ready, as soon as we get those slides up, we're good to go.
Great. Thank you very much, Jay. Can everyone see my screen?
Yes.
Fantastic. So as Jay said, I'm an advisor to Professor Shiller. And what I'm going to do today is talk a little bit about the CAPE ratio, what it's telling us. I'll also talk about how we've used it in the indices and give a little bit of a review of 2020 in terms of the index performance. And also actually going to catch us up to what's happened year to date, because as Elias said, there's been some interesting moves. And then I'll finish off with a little bit of some forward-looking aspects. So the first thing is the CAPE ratio stands for the cyclically adjusted PE ratio. And what Professor Shiller came up with in the late 80s was that instead of looking at a 1-year earnings, why not look at a 10-year earnings? So that 10-year earnings enables you to look through a business cycle. Professor Shiller thinks that, a 1-year PE ratio is just too short. So he developed this ratio and came up with a very interesting innovation. And what he found was that when the CAPE ratio is high, as you can see, for example, when it's above 40, the returns are low. And vice versa, when the CAPE ratio is low, you get positive returns. And that's really just a sort of simple tenet of value investing. Now, what's happened to the CAPE ratio recently in the last sort of year and a half? So we started 2020 at a CAPE ratio of about 33. And then actually at the peak of the COVID trough, the CAPE ratio dropped to 23. So that was pretty cheap, as you can see by historical standards. And then where we stand today, the CAPE ratio has actually gone back up to 35. So the market is looking a little expensive, but that doesn't necessarily mean that there aren't cheap things to identify. And what we do with the CAPE ratio, we use the CAPE ratio at the heart of the two indices that Jay mentioned earlier, the Shiller 10% Risk Controlled Index and the Shiller Global. What we do is essentially we use the CAPE ratio to identify either cheap sectors or cheap single stocks, and then we indexize them. Oops. So what happened in 2020? So we all know the story. Professor Shiller's spin on is that it was really a sort of narrative-driven market where it was really the work from home and the fear of missing out. So everyone remembered the crash of 2007-8 and how quickly it rebounded, and people wanted to get involved. So he very much thinks it was kind of a story-driven recovery. We all know that the work from home names that benefited were the information tech sector, communication services, and consumer discretionary that benefited from Amazon, increased spending online, or Lowe's and Home Depot. So that was the story of 2020. Now, the other sort of thing that is less obvious to some people is it was a huge year of sort of what we call factor dispersion. So if you're looking at cheap stocks, which can be growth stocks, or expensive stocks, or stocks that have got positive momentum, what I show here is the S&P 500 factors, and the difference between growth and enhanced value was about almost 44%. So you think about last year, what a tumultuous year it was. That is a huge dispersion. In fact, one of the biggest we've ever seen. So, that was very interesting, and that's driven the market up until, let's call it 2 weeks ago. And we've begun to see some interesting changes where, the value factor has begun to perform. And of course, today it's all reversing. So it's a very interesting and uncertain time. Now, what I'm going to talk to you about is the Shiller Barclays Index. And, this index has been live for, the underlying base index has been live for about 8 or 9 years. And the risk controlled index has been live for 6 years. So what we did was we wanted to take a look under the hood and really understand the characteristics of the index. So what this graph shows is if I just took a value index and said, let me understand the characteristics, and sort of it's a regression, what we would find is that the value index would be the orange line. And then if I looked at a pure growth index or a momentum index that had names like Amazon, Tesla, and all the other, and some of the other FANGs, that would be the gray line at the bottom. So what we see is, and the Shiller index is the blue line. Now what you can see, it's really flipping around. So it's actually a dynamic index, and it's a sort of a value-oriented index, but it flips. So if you think about 05 to 07, that was bull market, this index was a bit value orientated. You can see it leans towards the orange line. And then, after the crisis, let's call that, market started to recover 2010. It's been predominantly, a growth index, and because it rotates through sectors. What we do is we rotate through sectors and we buy the cheapest sectors. And for the last couple of years, it's really been growth names. So we've actually seen tech and communication services as cheap. However, what you can see is that actually in March, the index dramatically rises and becomes more value orientated. So what happened in March, we actually started buying financials. They were just incredibly cheap. They've been very depressed for many years. And we actually also have been long tech. In the beginning of 2020, this index was long tech. And then middle of the year, it actually dropped tech. Just to give you a sense of how expensive technologies become, it was the CAPE ratio for the tech sector, started the year at 39. And its peak in the summer of 2020 was about 52, 53. And it's actually since dropped back quite a bit. Funny enough, actually just a couple of days ago, we actually just went back into tech. But right now, the key thing that's driving the sort of index characterization is that we're long financials, and those are value orientated. In 2020, we actually also avoided the energy sector. That was one of the contributed to a very negative performance, and energy's now got very small in the overall S&P. We were long industrials. So how does that translate into performance? So here's the long-term 10% risk control index versus its benchmark, the S&P 10% risk control index, and we've seen solid outperformance. So what was the story in 2020? I think the first thing to note is, there's been a bit of skepticism about these risk control indices, but I think they really allow you to sleep well at night. This risk control mechanism, I was designing some of these in 2006, and they really have actually worked very well. They control the downside. So you can see here that the S&P fell about 34, 35%. The risk control indices fell, around about sort of 12, 13%. So, that's a significant sort of buffer that they have given you, and then they've picked up some of the rebounds. So they are much more stable. And then sort of diving into this, looking at the Shiller 10% versus the S&P 10%, what you can see that the Shiller, outperformed by 1.9%. Vol was a little higher, but I think critically the drawdown was a little lower. So now what's happened, year to date? So I think it's a really interesting time. So what I wanted to sort of take a step back and really, let's have a look at where we are from a long-term perspective. So what we show here is a graph of growth index divided by a value index. And we go back to the 70s. So what you can see clearly, 2000, you can see the NASDAQ bubble, and you can see again that we've got a little stretch now. But and it's hard to predict what's going to happen, and that's one of Professor Shiller's things. He's kind of saying, well, markets could go a little higher. We're not as anywhere near the sort of peak as the NASDAQ. But on the other hand, value is depressed. Their value is cheap, and some of the growth names are starting to look expensive. I'll give you some context there. Tesla, when it was at around about 900, had a PE ratio of about 1250. So, what does that mean? That means it's going to take you 1,250 years for Tesla to earn its actual, to earn back the amount to justify the share price. So that's a long time. It's, as I just looked an hour or two ago, it's back down to 900, but that's still a very stretched PE. And Elias pointed to the fact that, there's some interesting things happening in the market. We've seen lots of headlines of some of the growth stocks that are tumbling, and of course they're kind of coming back up today. So I think, it points to a difficult environment. We think that the Shiller Index, with its dynamic ability to switch between growth and value, it's a sensible play, but, we do think you should remain diversified. So here's the year-to-date performance. It's kind of been an interesting year because normally these indices track quite nicely and the Shiller might outperform a little, but we've seen a big divergence where in January and February, actually we dropped tech. So we lagged a little. And what we've seen now is we saw at the end of January when tech fell, we did quite well. And we've actually, funny enough, as of Thursday, we rebalanced back into tech. So we picked up a bit of performance. But it's an interesting time, hard to predict what's going to happen. Now, I'm going to talk a little bit about the Shiller Global Index. And just to briefly summarize what this index does, it takes 3 undervalued stock indices. We use the Shiller Cape ratio to identify cheap single stocks. And we have US stocks, European stocks, and Japanese stocks. So that's a nice diversification play, and I'm going to come to some of our forward-looking forecasts, and you'll kind of see why it makes sense to be diversified. And actually, we also include commodities and bonds as well. So it's a real sort of stable package. Now, just to get a sense of, how dynamic are these underlying equity indices, I ran the same regression, and what we found is that they're a little less dynamic. They're more value orientated. So the red line this time is the value orientation. The gray line again is the growth, and then the blue line is the Shiller single stock index that we're showing the US one, and you can see that it's a bit more value orientated than the sector rotation product. Now this index always selects stocks from each sector, so that's why it's got more of a value orientation. It's just using the Cape ratio to select the cheapest from each sector. And you can see it's deeply value orientated. And what we've seen is that value has actually done very well. So, overall, this index has struggled a little bit because it's got more of a value orientation. We've seen growth do very well. So here you can see what I've done is I plot the graph of the MSCI World and the MSCI Value. They're both in red. MSCI Value is in red at the bottom. And you can see that the Shiller single stocks, they outperform value, but they didn't quite match the MSCI World, which is the dashed red at the top. So we lag the overall market because of this value orientation. And we lagged a little in 2020. We're down 3.4% versus the S&P Global 5% Risk Control Index. However, interestingly enough, as the value stocks in the last month or two have done very well, we've seen the Shiller Barclays Global Index perform very strongly. So this has really been driven by 2 things. One is value as a sort of factor has come back. And what's really happened is one of the sectors and the stocks that have deep value characteristics are financials and energy and materials, and they've all performed very well. Financials typically do better when there's a steep yield curve because they can sort of borrow cheap and lend out more expensive, and they make a bigger spread. So financials have had a fantastic performance, and that's helped drive the global index. The second thing has been commodities. We actually can go into commodities based on momentum. So we haven't been in commodities for a while. And in January, the global index picked up commodities. And commodities have risen as some of these inflation fears have begun to take hold. And, interestingly on inflation, I was discussing it with Professor Shiller, and, we were talking about it in January, and he was just saying, he feels like the narrative of inflation hasn't taken hold. And then just 2 days ago, we were looking at the number of Google searches for inflation, and it is rocketed. It's almost the highest in the last sort of 10, 15 years. So we're kind of beginning to wonder, is that inflation narrative beginning to take hold? And, this index, having commodities, I feel is given a nice bit of performance and helps you certainly if that narrative, that inflation narrative begins to develop. So I want to wrap up before we take some questions. The first thing is, what do you do in a world where everything seems expensive? Well, I would argue that actually you can still find some cheap things. You don't have to buy the NASDAQ. You don't have to buy the S&P. You can look within the NASDAQ and find cheap sectors, or you can look within single stocks and find cheap sectors. Now, what we see here is a graph of the Russell 1000 divided by the Russell 1000 price, and that's the blue. So, this kind of the inverse of the graph I showed earlier, and it shows that value suffered. But the white line is the ratio of the PE of value divided by growth. And you can see that value stocks are still quite cheap. Their PE ratios are depressed. And you think about some financials and energy companies, their PEs are in the low teens. They're very cheap compared to the Tesla that I referenced of a PE of 900 today. So you want to be buying cheap things. That's kind of what Professor Shiller says, and that's a core thought. And then the last slide is what Professor Shiller likes to do is two other things. One is he has a number of surveys to kind of think and see what is the confidence level like. And this is his US Crash Confidence Index that he runs with Yale. And it asks people the question, what do you think the probability of a crash is? So, you can see that it's been declining through 2020. So people were confident, but you can see recently it's had a little bit of an uptick. So as markets have gone up, people are, pulling back a little, but the confidence level is high. And then the last thing that we do is Professor Shiller likes to use his CAPE ratio to sort of forecast 10-year returns. So what I've gone and done is I've forecasted the 10-year returns for the US, Europe, and Japan. And the US, its current CAPE is 35. Its average in the last 20 years is 26. So you can see it's a little expensive. So in the US, we're forecasting real returns of about 3.5%. So that's fairly muted compared with the past. So you can almost sort of think about like this as buying Tom Brady. Tom Brady's won 7 Super Bowls. Is he going to win 7 going forward? It's a little bit like the S&P. It's had some huge hits in the past, but is it going to return some huge hits going forward? Tom Brady might win another 1 or 2. I don't know, but so we think it makes sense to be diversified. So take a look at Europe. Current CAPE is 21. 20-year average is 18, so it's it's kind of close to its long-term average. And Japan at 23 is just a smidgen below its long-term average. So we expect returns in Europe of about 5%, and in Japan, let's call it 6.5. So we think it's sensible to remain diversified. Do consider Europe, do consider Japan. Their returns have been a lot lower, and the US has been very high. And if we see a little bit of US giving up some leadership and Europe and the rest of the world, Japan doing well, it makes sense to be diversified. So that ends the portion of my presentation today. Jay and Scott would be delighted to take any questions from the audience as well.
Well, thanks, Laurence. Appreciate you getting under the hood and giving a little bit of detail on both the CAPE Index and the Shiller Global Index. And thanks to Elias for giving us some great commentary on the rising rates and rebound in earnings. And I think due to time, we're not going to open it up for questions, but I'm going to turn it back over to Scott at Gradient.
Thanks, Jay. And thank you, Elias and Laurence, for joining us today, and thank you to all that attended. If you'd like to discuss the Athene BCA with the Shiller Barclays and how that may fit into your current product offerings, you can either reach out to your VP of Marketing, or you're welcome to contact myself as well. Again, that's Scott Walker, Annuity Product Specialist, and our number here is 800-407-4137. Have a great rest of your day.
Thank you, everyone.
Thank you.
Bye-bye.